Welcome. My name's Jeff Driver, General Manager of Business Development and Investor Relations for AMCIL Limited. I have with me today Mark Freeman, who's the CEO and Managing Director of AMCIL. But Mark's also the Portfolio Manager for AMCIL and has been doing that for the last 2.5 years now, Mark. So Mark, over to you and talk about the results.
Okay, so we'll just start with the result numbers and then I'll talk about the portfolio. The full year profit was $6.7 million compared to the previous corresponding period of $7.5 million. Dividend income was down slightly as bank holdings were reduced. The directors have declared a final dividend of 2.5 cents per share fully franked, as well as a special fully franked dividend of 3 cents per share, bringing total dividends for the year to 6.5 cents per share. The special dividend reflects part distribution of the significant amount of realised capital gains and franking credits generated from the trimming of the holdings in Wesfarmers, some major banks, and the complete disposal of the Commonwealth Bank of Australia, as valuations for these companies became very stretched. AMCIL delivered a portfolio return, when you include franking, of 6.4%. This is below the ASX 200 accumulation index, which returned 15.1%, including franking. But I'll touch on the factors behind this later. The management expense ratio of the company was maintained at 0.56% with no performance fees.
So Mark, I mentioned you've been managing the portfolio for the last 2.5 years, and obviously the performance over that time, you've actually been ahead, but certainly over the last 12 months, the AMCIL portfolio underperformed. You also got comments about sort of that shorter term period and also the 2.5 years you've been managing the portfolio?
Yeah, look, it is interesting to reflect back on that sort of 2.5 years, and I have managed AMCIL in the past as well, but over the last 2.5 years, so we sort of took back over the portfolio, made some changes and really focused on being pure to our frameworks and process. And then the stocks we held performed particularly well over 2 years, and it was really strong performance and it wasn't to be maintained. And then a bunch of those stocks that drove a lot of very strong performance came back during the year. So if you look at stocks like ARB, Main Freight, Reece, James Hardie, just to name a few, had weaker periods over particularly the last 6 months. And so what the result was, we had a pretty tough 6 months, but when you stand back and look at the 2.5 years, because we really haven't made a lot of fundamental changes, we are still comfortably ahead of the index over that period. So, and that's pleasing, and we're still happy with the stocks we have in the portfolio.
So Mark, you mentioned about the banks, I guess, as being sort of the major underweight position, I guess, within the portfolios. And the selling of Wesfarmers. AMCIL is obviously a much more active portfolio in terms of buying and selling. I mean, what were sort of major changes you made through the portfolio?
So we had the complete exit of CBA, and again, when you look at long-term valuation metrics of the banks, they're pretty extreme, particularly CBA, and we think CBA is a fantastic company. It's very well run, but to see the PE get to 30 times when the long-term average is probably more like 15, it's just too extreme for us, and so we exited, and we have been reducing NAB and Westpac. They have very small positions in the portfolio at the moment, and so they've continued to run, so that sort of dragged a bit on our performance, but we think it's the right thing to do for the portfolio, particularly where we've been able to allocate some of our capital into.
I suppose one of the other factors has been the sort of CSL's sort of largest holding within the portfolio. That's had a sort of opposite year to CBA.
Yeah, well, it is interesting because when you compare the two, the CBA earnings or profit outlook's pretty flat, but CSL, we're looking at some pretty good earnings growth over the next few years. Yet the PE on CBA's gone to a record high, and CSL's PE's gone down. And so, we are now positioned not in a bank that's very expensive, but we are in a good quality growth stock that's at very low multiples compared to what it's traded historically. So that's again impacted performance over the past 6 months, but we think it's the right positioning going forward.
And you talked about the investment process. I guess, as I said, there's a lot more sort of growth stocks within the AMCIL portfolio, given its focus is to deliver sort of more capital growth than dividends over time. So what are the sort of any newer stocks you've added to the portfolio that fit into that sort of category?
Yeah, so pleasingly, even throughout the last year, the activity we did continue to add positively to the performance, and that's been the consistent path over the last 2.5 years. We still like to capture, I guess, quality emerging companies, particularly ones that line up against our frameworks. And as people would know, we added Technology One. I think it was at the end of the last financial year. That's really come through. It had been a founder-led company historically, annuity-type revenue, strong balance sheet, very high return on equity, plenty of growth opportunities. That's the sort of lens we look through. We bought that. So during this year, we added Sigma, which has been an excellent investment. We did that before the ACCC announcement. We've been building Life 360. So both of those are founder-led companies with strong growth opportunities. So Life 360's done very well. As well, we added EVT, which is another founder-led company. That's more what I call a cyclical play, but they've got a strong balance sheet. So again, it added up. We had a sell-off during the year when Trump came in. We added some more hub in that environment. So we'll still be able to find stocks that pass our lens, get money into those. And as I said, they've added real value to the portfolio.
Okay, so the next 12 months is coming up. I said AMCIL is a bit more active in the market than perhaps some of the other funds within the, sort of our group. How do you sort of see the next 12 months for AMCIL?
Yeah, look, we're pretty comfortable with the positioning now because I said some of our positions that have been there for the full 2.5 years did well at the start, have drifted back. And so they look pretty fairly valued compared to a lot of overvaluation in the market. We will look at stocks outside of growth stocks. So we've taken a position in AMCIL, for example. We think that's really a play around the recent acquisition they've completed. When AMCIL have done acquisitions in the past, you can get an earnings growth spurt. So it doesn't have to be just around quality growth, which have run pretty hard. And we've added a little bit of Region Group because of the high yield. So we can look at those sort of stocks as well in a very expensive market. And so we're just being pretty careful. We've got a little bit of cash at the moment, and we're just very cautious on valuation. But as we know, the market will continue to give us opportunities, just being prepared for some of those. And there's a few things at the moment we've been looking at that still we think gives us a bit of an opportunity to put some money in.
All right, Mark. Well, thanks for your time.
Thanks, Jeff.